Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 154th VideoCast, 144th podcast for the week ending September 29th, 2022. Long day was in the city to do an in-studio with Yahoo Finance. As a matter of fact, we're going to kick off this VideoCast podcast with the 7-minute in-studio interview because it really encompasses all my thoughts in this kind of volatile week we've had and how I see it playing out over the next 3 months. So if you want the Cliffs Notes version of this videocast, listen to the next 7 minutes and then go watch the hockey games. But here we go. Well, first off, we're in a period of seasonal weakness. So September is the worst month of the year, and this happens to be the worst week of the worst month of the year. So there's max pessimism. It does remind me a bit of June when we were coming into earnings season. There was max pessimism. Expectations were extremely low. We have a very similar situation right now. Earnings growth is expected to be just 3.2% for Q3. Prices have doubled more than that. So you're effectively looking at negative earnings growth, and the economy just doesn't look like it's going to go that way. So it sets up for a positive surprise into year end. We're also going into the election, and the likelihood based on the data is that there's going to be gridlock after November 8th. That too can be bullish for the stock market. It means no new taxes. It means no new regulation. And the market likes that. Regardless of who's in the executive branch, it's good to have gridlock. The less that gets done, the more Wall Street likes it.
Looking like the Republicans take the House and Democrats hang on to the Senate. All this pessimism going around, do you share it?
I don't. I look at the way managers are positioned. Okay, we've got the highest cash levels since the pandemic lows, since March of 2009, since the tech wreck. Usually when things get to this level of extremes, it's a market turning point. And we just don't know what that catalyst is going to be. What we have seen is central banks around the world blinking. So the ECB, they came out with that facility to buy Italian bonds on the periphery. You saw Bank of England have to buy gilts. And the question is, when is the Fed going to be next? And the key thing here we have to keep in mind, Chair Powell has this idea that he wants to be Paul Volcker. The difference between Paul Volcker and today is when Paul Volcker was raising rates, the debt to GDP was at 30%. Today we're at 122%. So for every 1% he increases the Fed funds rate, that adds $285 billion to the deficit. So it becomes unsustainable. And sooner or later, like all politicians, they get disciplined by the credit markets. And when municipalities and companies have to refinance and the government has to refinance and the interest costs become unsustainable, they'll have to back off. We've just come off of 3 emergency hikes of 75 basis points. Since 1983, you've had about 88 hikes. 75 of them were below 50 basis points. So what we've done is pretty material, and we have to kind of just take a pause and see how that works.
And as we sort of wait for some of these things to work their way through the real economy, Tom, what looks attractive to you right now? As a lot of people are wondering if the Fed risks over-tightening.
There's no question they risk over-tightening, that's for sure. One of the groups that we like that's kind of less sensitive to the interest rates, although people think it is sensitive, is biotech. And the last tightening cycle we had, in anticipation of it, the biotech group dropped about 50% from 2015 to early 2016. Over the next 2 years, while the Fed was increasing the Fed funds rate from basically 0 to 250, you saw that group recover about 130% off the lows. We're seeing the 2 key catalysts start to work out. That is major deal activity we've seen since May. It cooled off a little bit in the fall with rates, and major drug activity, yesterday being the biggest with Biogen. That's huge for Alzheimer's, and we're going to see more investment and more excitement come into the sector that has been really left for dead and very few people are focused on right now. Despite the 56% move off the May lows, we're now consolidating. I think as you look out over the next 1 to 2 years, Rochelle, there's opportunity there.
Tom, what do you make of what's been happening in the tech sector and the selling that we're seeing there? Once again, we're seeing a lot of these larger cap tech names lead to the downside today. Apple, Amazon, Meta, Google, among the worst performers in today's market. What's it going to take to stop some of the bleeding there?
Yeah, it really is a function of rates, and it really is going to be a question of when the Fed blinks. And what we need to see is some better inflation data. We need to see employment cooling. This morning didn't help, but we'll see the jobs report coming up real soon. And once you see some stabilization in rates and the dollar, one of the key things that I look at, Shauna and Dave, is the weekly commitments of traders report. And I look at the commercial hedgers because they're always right and they're always early. And what we're seeing is the commercial hedgers are the most short the dollar that they've been in a long time. They're most long the 10-year treasury than they've been in a long time. And they're long S&P futures. They've been right, and if you look at the last 5 peaks and troughs for those instruments, it's always preceded major market turns. So I don't know if it's in the next 2 days or the next 2 weeks, but I think within the next 2 months is realistic. And I would say if you're going into the end of the year excessively pessimistic, there's really no one left to sell. The National Association of Active Investment Managers today came in at 12.86% equity exposure. They were at 11% at the pandemic lows when we didn't know if we'd have a vaccine for 4 years. So I look at things, active investment, the Association of Individual Investors, at 20% bullish. That's consistent with pandemic lows, great financial crisis lows. And I really don't think we're in a situation like the pandemic where the uncertainty was that high, or like the great financial crisis where banks were in a bad shape. Banks are in a very good shape right now.
The action in the 10-year, we mentioned it earlier. What's it telling you is around the corner?
Well, it's pricing in that the Fed is going to keep going on autopilot. And the last time we heard autopilot was December of 2018, when Powell came in and made his first mistake of 3 major mistakes and crashed the market 16.5% within a couple of weeks right before Christmas. Mnuchin had to call up 6 banks and get a liquidity line. 5 days later, Chair Powell backtracked. He walked back his language on that autopilot. Within 3 months, we were at new market highs. Last year, when inflation was at 4%, GDP estimates were at 3.8% for this year. They thought 10 basis points made a lot of sense and inflation was transitory. Now that GDP is at 0.2%, collapsing, inflation is coming down. They think 4.6% makes a lot of sense. It's like a dog chasing its tail. They're forgetting about the lagged effect of monetary policy. And I think the credit markets will let them know very, very quickly, just like Bank of England, they will walk back or they will pause, and that will be very, very bullish for equities, including tech.
And Tom, as you look at some of the stickier parts of inflation, when do you expect those to start subsiding?
Yeah, that's going to take some time. If you look at post-World War II was the last time we had debt to GDP this high, over 120%. And what they basically did was they talked hawkish and they act dovish, very similar to what they're doing today. And they did run inflation above trend, about 3 to 5% over the 5 years following World War II. And what you saw was debt to GDP drop from 120% down to 63% in just a handful of years by running inflation above trend. The key thing about the Fed, where they've been right, is that hawkish talk has brought down 5-year inflation break-evens from 359 in March to 237 yesterday. So they're anchoring those long-term expectations. They are succeeding with the language. Now they just need to ease up a little bit on the action. They've gone a little bit too much the last 3 hikes. You might kill the patient with too much medicine.
And now I want to thank Taylor Clothier, Sydney Freed, Shauna Smith, David Briggs, and Rochelle Akufo for having me on that Yahoo segment. That was fun to be in studio again for the second time. And want to thank Sarah, Alicia Nieves, and Vince Molinari for having me on Finance TV on Tuesday to discuss the Fed and others. So these you should go through at your leisure. We're not going to spend time on that now. Also want to thank Sarah Al-Qaidi and Marianne Starr Inake for having me on CNA Asia. That's like the Bloomberg of Asia. They're out of Singapore. Not the Bloomberg, the BBC rather. Want to thank Phil Yin and Dalal Pektas for having me on CGT in America on Friday night to discuss the Fed and outlook. And then I want to thank Aaron Bry for having me on Benzinga on Friday afternoon to discuss Fed walkback, positioning, my investment philosophy, and my background in the hedge fund industry. This was really interesting. This was off the cuff. He called me literally 15 minutes beforehand. Had to do a quick shave and we kind of let it rip. So hope a lot of you find that valuable. There was some information in there, people looking to get into finance and et cetera, which may be helpful for many of the younger listeners. Also want to thank Ellen Chang for including me in her article on biotech this week. Definitely want to check that out at thestreet.com. And we'll start with our quote of the week, which is Benjamin Graham: the intelligent investor is a realist who sells to the optimists and buys from the pessimists. Well, there are no optimists this week, so you'd be buying from pessimists, and you'd probably be well served in doing so, assuming that you're buying high quality at a reasonable valuation, and we'll talk about some of that. And then second quote for this week, which I think is very appropriate: don't worry about looking good, worry about achieving your goals. And that's really the whole name of the game. When you step back and you own high quality businesses and they've gone a little bit against you, what you have to ask yourself is this: 1, 2, 3 years out, is this business going to be smaller or bigger than it is today? Number one. And number two, irrespective of price, has my ownership percentage in the company changed? And that's really what it comes down to. If you owned an apartment building with a few partners, 100 units, and you own 25%, and you go through a recession and your vacancy rate goes up to 10%, would you sell that apartment building at 50% off just because it's temporarily impaired due to a slowdown? Or would you say, well, 3 years from now, it's going to be back at 5% vacancy, number one, and number two, the rents will probably be about 20 or 30% higher, and my 20% stake on the basis of the leverage could be worth another 40, 50, 60% more than it is today. Well, in the stock market, it seems like more people want to sell when it's 50% down than take the long-term view, or they just haven't done the work to know that they own a quality asset, and you should think about it no differently than that, irrespective of whether Jay Powell wants to be a big boy and pretend to be Volcker, which is not going to be tenable, because Volcker was raising rates when debt to GDP was 30%, and he could raise them as high as he wanted with no real consequence, whereas Powell either didn't get the memo or is aware of it, and it's just posturing to bring down long-term inflation expectations, which he's been very successful about doing. Because you simply at 122% debt to GDP, that's where you get caught up. So as you saw in the live Yahoo studio, a couple market stuff. Why sell Rosh Hashanah and buy Yom Kippur trade is a tough call. Well, that seems to be on track. As a matter of fact, I just looked up. Yom Kippur is next Tuesday, and the old axiom is that you sell, which Rosh Hashanah was earlier this week, and then you buy because they're supposed to get rid of worldly goods, etc. And then you buy Yom Kippur, which is next Tuesday, and that kind of sets up pretty well in terms of how pessimistic things are becoming and some type of resolution. And I think many people are looking at a situation where first off, as I said in the segment, September is the worst month of the year statistically, and this week is the worst week of the worst month of the year statistically, and that has held true in spades this year for sure. But then it gets better from there, and I think most people, because of the 1987 and because of the famous crashes that have happened in October's, think that October is going to be worse, but the facts just don't bear that out. And I could see a situation where everyone's waiting for the next shoe to drop and October winds up being a little better than expected, similar to how we were set up going into June earnings with expectations very low and a lot of positive upside. So that may be hold very true. Wharton's Jeremy Siegel accuses the Fed of making one of the biggest policy mistakes in its 110-year history. I agree. I posted some of the videos from Friday, and then he was back on Monday, and I think I've been pretty explicit in the 5 media appearances which have been thematic about the Fed this week that's the case. Now, Kramer put out this chart from Larry Williams, and Larry Williams is a technician that's been around. He's been around for like 50 years. And he uses this timing solution software, which we have. And basically what he's showing is how if you overlay the current inflation cycle to 1980, and also, by the way, if you do it to 1974, which we talked about in the article of the week, there's a high correlation that it's going to roll over, and it's going to roll over imminently. And that would also be consistent with his view that we were going to take another leg down to retest and then be off to the races into year end. I mean, that's a normal seasonality, but I also just think, as I said this afternoon at the Yahoo studio, is there are no sellers left. We hit 12.68% equity exposure for the National Association of Active Investment Managers. We haven't gotten that low since the pandemic lows. So while these metrics that I keep referencing don't cause the stock market to go up, eventually what they represent is that you've basically run out of sellers when the cash levels get that high, and any good news that people aren't prepared for, it just creates a panic buy-in. And what's beautiful is after today's reversal, no one's going to believe the next big move. So if you get a 500 point move again next week after Yom Kippur, or God knows what these days you got to count on to get a turn in the market, but no one's going to believe it, and that's the conditions precedent for it to keep going, because people continue to disbelieve it, the wall of worry, and then finally they'll be forced to capitulate, and then you'll just have a tidal wave of liquidity come into the markets, and it could be on a very little headline. It's just, when sentiment changes, it changes quick. I mean, for heaven's sake, Loretta Mester, like, really, that's what caused the market to crash today? Like, the Fed president of Cleveland? I don't think so. It's just this normal volatility, this chop until something changes. And as was the case in June, it was earnings. And I think that'll be the case today, moving forward into earnings. Because if you think about plus 3% earnings growth for Q3, prices have doubled that. So if all they did was keep pace with prices, you'd be looking at 6%. God forbid they actually had any underlying growth because of the $5 trillion of liquidity that's still in the system, which everyone keeps forgetting about because we've hiked rates 3%. The implication is that you've had negative 3% real earnings growth, which I just simply don't think was the case in Q3. So you should see a lot of upside beats. And like even Nike, who, reported after the bell I was listening to, they did better than expected in China. I think it was like they were supposed to be down like 15 to 20% in China. They were down 11% or something to that effect. So Tom Lee's out. If you can guess, he's bullish, sticking with his year-end stock market forecast. And his basis is, he says Fed could do far less tightening as the market is doing the Fed's work. If you look at the 2-year yield, he's absolutely right about that. He's keeping it at 5,100. Bold, baby. But, as manic as it's been to the downside, that would be surprising, but not outside the realm of possibility. I mean, I could definitely see 4,800 if, again, remember, going into Q2 earnings, everyone said that estimates were going to come down by 20%. That was consensus. They came down like 2% during the earnings season. They're now down 3%. Going into this earnings season, they're all saying they're coming down 20%. What these analysts are not accustomed to is an inflationary environment where, while, general inflation, call it, mid-single digits, some of these companies use the opportunity to raise prices much more. And even though that's nominal gains, it's still denominated in dollars, which is EPS, which means that earnings probably grew, not adjusted for inflation, actual, as reported, much more than people expected, because inflation was much more than, normal. Okay. 6 versus 2, that's going to add a lot to the bottom line. And I think people are underestimating that. And I think people are everyone's put through price increases by now, and we'll just reset at this new plateau. And inflation won't go up at the same pace, but prices are not going back down. They're just going to go up less quickly, and most likely, like post-World War II, in a 3 to 5% range for the next few years to bring down debt to GDP by design, moving forward. So what Lee is saying here is that which, by the way, he's calling for 37%, maybe 39% after today, rally into year end. The idea that forward-looking indicators show inflation is indeed beginning to cool off and will lead to a less hawkish Federal Reserve in 2023, contrary to Powell's most recent comments. Our continuing analysis shows leading indicators point to disinflationary deflation, Lee said, highlighting the ongoing decline in the Manheim Used Vehicle Index, which we've covered. Recent commentary from FedEx, Costco management about falling prices and lower oil prices. Plus, we've talked about inventory builds in recent VideoCasts. Inflation is dropping like a rock. The Fed could do far less tightening as the market is doing the Fed's work. Take a step back. If inflation by December 2023 is 2.8%, and the Fed funds is 4.6%, this could be viewed by investors as constructive. After all, monetary policy by then is already restrictive and there would be room to cut rates. That's December 2022. This was a typo by the Business Insider. U.S. corporates remain resilient. Fourth quarter, well ahead of the... Okay. Resiliency by both businesses and the U.S. consumer was on full display in Costco's fourth quarter earning results, which revealed comparable same-store sales growth of nearly 14%, well ahead of 12.5% estimate. Now, if you adjust that to inflation, you could say, no, that's only 10 or 8, but it doesn't matter. You get credit for it on the top line and the bottom line. So when you're in the Goldilocks range, 3 to 5%, if we start to get into, if we reaccelerate to double digits, then it's, all bets are off, but that's not going to happen. So finally, investor sentiment is rock bottom and worse than great financial crisis by some metrics. We've covered those metrics. It goes to AAI sentiment. There are green shoots. So we agree with him. Kalanovic was out saying the same thing at JP Morgan, and he is viewing that U.S. PMI is in contraction territory at 49. Therefore, the phase of strong payrolls will likely move behind us. We'll see in the jobs report next Friday. That could be a big deal. Tomorrow we get PCE inflation. It's backward looking, but God forbid we actually get a number that comes in lower than expectations. That could also be a positive catalyst. We'll see. Not holding our breath on that. And then finally, peak inflation combined with attractive equity valuations and extremely depressed investor positioning suggest a market bottom could be imminent. We agree. He also cites the AAII, the fear and greed, which we covered in our article this week. And instead, according to Kalanovic, a dovish Fed pivot could be the catalyst that sparks the market higher over the next few months. It should be increasingly probable that the next few months could see some dovish tilt by the Fed. That would help drive another tactical bounce for growth stocks, according to the note. And we agree. And, right now, very few people can see that. But, 2 days ago, very few people could see the BOE capitulating and buying bonds. The credit market always dictates the policymakers and the politicians sooner or later. This time will be absolutely no different. Banks have to, not only does the government have to refinance, but businesses have to refinance, municipalities have to refinance, and these levels are simply unsustainable. Moving on to China updates, casino shares gain on hopes of renewed tourism in Macau, so they're lightening those restrictions. There was one day they were all up like 29% early in the week, Melco, Crown, and we've got the whole basket, Melco, Vegas, Sands, and Wynn. Alibaba is pouring $1 billion into cloud computing. The move is critical for its growth. We've covered this, 36% of share. The sector, according to McKinsey, is going to double in the next 2 years. That could be $20-30 billion to Alibaba's bottom line. So they're investing to retain and probably gain share. China's 5 years behind the U.S. in digitization. It's a big story. Oh, and by the way, they're trading at $225 billion. They got $100 billion of current assets. So then you're basically paying $125 for the cloud business, which could do $20 billion bottom line, 5 times. That's way too low, particularly with the growth rate. Oh, and you get an e-commerce business that's basically free. I had dinner and lunch in the last week with this huge developers from Istanbul, Turkey, and one of them was telling me that the business that Alibaba has that they bought in Turkey is just crushing it. Like they're growing like 23, 24, 25% a year top line, and they're going to be aggressively expanding in surrounding nations very, very soon. So that was nice to hear. While everyone's pessimistic, they continue to grow outside of China as well as inside of China. Earlier this week, this in my view is the canary in the coal mine. Fed Evans says he's getting a little nervous about going too far too fast with rate hikes. Even Kashkari, who was Captain Dove last year when inflation was quote unquote transient, now all of a sudden he's super hawk. He also voiced concerns about going too fast. But he's gunning for the job, and he wants to pretend that he was on the right side of the trade both times. And as we know, it sadly wasn't the case. And look, it happens to all of us. Myself included for sure. Russia to annex more of Ukraine on Friday at the Kremlin. So people, this is kind of bad news for sure, obviously. But if you look at what they're annexing is the Russia separatist region of Luhansk and Donetsk, which we said when this started in January that, sooner or later, that's how this was probably going to end. They were going to get those two areas that identified as Russian, and then it was going to call it a day. The question is how many billions of dollars in lives would be lost in the process? Well, so far it's tens of thousands of lives and probably hundreds of billions of dollars. And the end result may wind up being the same. While they won't be recognized for this annexation, as they said would be the case with Crimea, ultimately that stuck. And in this case, I think if Putin, it's like the Golden Bridge in Sun Tzu, The Art of War. You have to give the enemy a way to save face when they lose. And Russia has certainly lost with this, the amount of lives, the amount of treasure. They did not count on NATO unifying and basically fighting Russia through Ukraine as a proxy, giving them weapons and giving them money. But if Putin was clever, what he would actually do is declare annexation of these two regions tomorrow, which very few would argue. Certainly Donetsk and Luhansk identify as Russian. And then he would say, that's it, we're done. We started this in order to assimilate those people who identified with motherland or whatever he wants to say in some grandiose speech. And our mission has been accomplished, and we will not be pursuing further avenues. And that's that. And in that context, if that would be the beginning of negotiations, and he said, if you could wake up on Friday or you could wake up on Monday, and no one's positioned for any positive outcome with Russia-Ukraine. I can't tell you how many thousand points that would be worth, but it would be worth something. And no one's positioned for that. I'm not saying it's going to happen, but I'm just saying there are a lot of things out there between earnings, between the Fed eventually breaking down because of the credit markets, like BOE, like, by the way, ECB. In the name of the article we wrote this week is 3 down, 1 to go. Why? Well, the Bank of Japan were the smartest ones. They never even pretended to tighten. They're just like, we are going to cap 10-year JGB yields at 25 basis points. We'll buy unlimited amounts. So they never even pretended to tighten. ECB pretended to tighten. They had to go back in the market to buy periphery bonds in Italy, which are now at 9-year highs. And then shortly after, Bank of England had to capitulate and blink and start quantitative easing on the gilts. They say, oh, it's only for 30 days. It's until it has to be. And that's really what it's going to come down to. And then finally, the question is going to be the Fed, when municipalities start bitching that they're going out of business because they can't finance their pensions and because they can't roll their debt. And the same reason they backstopped the credit mark during the pandemic will be the same reason that they blink before the end of the year, in our view. Or sooner, or you get a good inflation print. So it's either going to be reactive, which would be negative, or proactive, which is going to imply that they've actually read a few history books and they can avoid the pain before it happens and the collateral damage and cost of a financial crisis. So that's that. Okay, this is from China last night. Brendan Ahern over at KWeb. He said there are reports that mainland China may soon shorten the quarantine requirements for visitors, perhaps limited to visitors remaining in cities. Meanwhile, there's some speculation that the whole country will reopen in 2023 or even shortly after the Party Congress. He says in August, it's October. This chatter may have contributed to a rebound in A shares overnight. People's Bank of China central bank injected $25 billion into the financial system through reverse repo operations following a similar injection yesterday. On the flip side, the central bank also implemented a 20% risk reserve ratio to help stem the fall of the renminbi versus the US dollar. This makes it more expensive to sell yuan to buy dollar-based derivative contracts. The PBOC is attempting to stimulate the economy while keeping the yuan at a reasonable level versus the US dollar. So while the rest of the world is tightening, China is easing as they open up after the National Congress next month. We should see good things to come. So that's where it's at. Here's an article from Reuters. Quote, there is some optimism. You'll get to see gradual loosening of some of the zero COVID restrictions that will at least provide some cyclical support to the economy. Morgan Stanley survey shows 42% of investors polled in September had increased China allocations over the past 3 months from 21% in May. Some fund managers think Xi wants to quickly get back to the business of supporting the economy. So, look, that could be positive. Next is China becomes hothouse of intrigue ahead of crucial Communist Party Congress. There were rumors swirling around all weekend that there had been a military coup in China and Xi had been removed from office. It turned out to be disproven, but where there's smoke, sometimes there's fire, and whether, they had a come to Jesus meeting and said, listen, you need to normalize your policy after the China National Congress, or nothing ever happened and just thousands upon thousands of people thought that was the case. We don't know, but usually where there's smoke, there's fire, and my sense is it's a clear message. The fact that there was a huge buy-in, particularly in India, etc., around this story tells me that there's a kind of a global consensus that a regime change would not be unwelcome, or a pivot back to pro-growth policies with the same leader would also be acceptable. But the no-growth policies with the same leader has not been acceptable, and that's going to change either by choice or by I would imagine there will be many powers that be in China that want to see a change if something doesn't change quickly. But it does seem that things are starting to change, which is constructive. China's central bank moves further to bolster the yuan. Citi, kudos to them. They upgraded Alibaba today. Excuse me. She said, price is attractive. Citi sees potential shares to rally 70+%. She took the multiple down, but she upgraded it as attractive based on valuation. It's about as useful as the paper it's written on, or worth as much as the paper it's written on, but better than a downgrade, I guess, right? Xi's aide, likely to be the next economic czar, stresses need for growth. That is very positive because that could be changing in a matter of a couple of weeks. Lifang, seen by analysts as frontrunner to succeed Liu He has expressed a more pro-growth stance than his predecessor. So that would be a big deal. We need a more focus on growth, positive for the economy. Friendship goes back to the 80s, etc., etc., etc. So he clearly showed that he would not hesitate to expand credit to boost growth. So it would be back to the future, game on once again, and that could be as quickly as a few weeks. The two most important charts in the world, in my view, is the dollar, which is actually down 2% in the last couple of days. We'll see if we get any follow-through. And the 10-year Treasury yield is down from 396 to 374 after the BOE blinked. So both of those are moving in the right direction. We don't hold our breath, but we keep a very close eye on these on a daily, hourly, and minute-by-minute basis. Okay, so stock down, 3 down, 1 to go. Stock market and sentiment results. In last week's note, we laid out our case as to why a walkback might be in the cards as it relates to the Fed's ultra hawkish stance. This week we made the case in the following media appearances. We've covered those. And the key, as we covered on Yahoo, so we're not going to spend a lot of time, is seasonal weakness is now starting to move into the rearview mirror. Earnings expectations are super pessimistic. I think we're going to have upside beats in coming weeks. Earnings season starts in the next couple of weeks. Kind of the Fed trip up. And Powell and company will have to walk back their hawkishness. Here's why. First reason is inflation's rolling over. So chart by chart, CPI and PPI, CPI versus gasoline price, inflation projections by JPM, Zillow rent index versus U.S. core CPI rent component, all rolling over. National rent index rolling over. You can see it in a different form. ISM manufacturing new orders to inventories rolling over. We talked about inventories in the past, how they have to discount to move it. We saw that in Nike today. Their inventories went, I think, from 26 to 43. So they're going to have to dump those. Why are inventories so high? Because they double ordered and triple ordered everything because they couldn't get it during the pandemic. Now all the ships are in. Now everything's happening. And they're stuck with all this inventory, which they'll discount, which is disinflationary or deflationary. Energy moderating, core services inflation moderating. Positioning depressed. Wage growth versus unemployment. The Manheim index. Here's what's interesting. If you look at the used vehicle index down 13%, it's not yet reflected in the CPI calculation of it, which is a decent sized weighting, and that will be reflected in coming months. So we'll start to see that as Tom Lee's talking about, and Marko Kolanovic. CPI 1 week market reactions versus S&P since 1970. It shows that when you had horrible reactions to CPI prints like we had a week and a half ago, it was usually at or near the bottom. And I think this time in September will be no different. We also had it in June when we got this summer rally. These are the Larry Williams inflation overlays, 1974 and 1980 to current day. And you can see how they just absolutely fall off a cliff. And it points to literally October 1st or, the end of whatever it is, Yom Kippur. So a lot of spooky voodoo pointing to the same inflection points. We'll see if any of them have any use. But in crazy environments like this, when fundamentals are thrown out of the window and emotions are ruling the day, it's worth paying attention to a few of these things. So those are from Larry Williams and Seth Golden on Seth Golden is a worthwhile follow on Twitter. He puts out a lot of good stuff. Here's from Carl Quintanilla and Liz Ann Saunders. These are the container ships we've talked about. Remember, there were like 120. Now there are basically 6. So the supply chain stuff is rear view mirror for the most part. Shipping rates are rolling over. Here's commodity prices and regular day things. Chicken wings are down 59%. Avocados down 63%. Lumber down 59%, actually lower than pre-pandemic. Aluminum 44%. Cotton 35%. Box pork. So I have no idea what Powell's looking at, but he's certainly not looking at the facts as of yet. But that said, he also has an objective to talk down inflation expectations, which 5-year break-evens are now 237, down from 359 in March. So that's huge. Home prices rolling over, rents follow that. Core goods inflation rolling over, rents drop for first time in 2 years. Shipper outlook, so that'll bring down shipping costs even more. Case-Shiller housing prices dropped the most since 2011. The second reason they'll have to pivot is because every 1% hike adds $285 billion a year to the deficit in interest expense. It was easy to raise rates when debt to GDP was 30%, and you could beat Paul Volcker, but now it's at 122, not so much. And you have to think about it. If you raise rates so much, who's paying that interest? Well, yeah, the taxpayers are paying that interest, but we don't collect enough revenues to pay for that. So what do they have to do to pay for the increased interest expense from the rates they rise is print more money. I mean, you can't make this stuff up. They're actually creating more inflation because they have to print more money to service the debt at 122% debt to GDP. If they just did nothing and waited for it to come down, they'd be in a much better situation. But it's short-termism, emotional knee-jerk. They're running the Fed like a bunch of day traders, and hopefully they'll wake up before it's too late. And as we saw with the Bank of England, even if they're in a deep slumber, eventually the credit markets will slap them upside the face and wake them up for them. So credit markets will force their hand when governments, municipalities, and companies can't refinance. It happened in the UK on Tuesday, ECB in June, which also sparked the summer rally, by the way. Hawkish talk and guidance working as inflation break-evens at 15-month lows. We just covered that. Manager sentiment and positioning for the apocalypse. We've covered the cash levels, highest since the great financial crisis lows and the pandemic lows. This is neither of those things. Lowest overweight equities in history. Highest recession expectations since March of 2009 and April 2020. In both cases, the market bottom was already in. Margin debt has collapsed lower than 2008 and 2009 pandemic lows and the tech wreck lows. So, and AAII sentiment below pandemic lows and great financial crisis lows. So you can't make this up. I mean, we're in nothing like those two situations, and yet people are positioned that way, which means when things flip, it's going to be more abrupt and it's going to be aggressive because no one's going to believe it. And those are the most painful ones. As painful as it feels like going down, it's going to be more painful going up, because what's going to happen is people have been beaten up so much that they won't buy it until it makes new highs, and they're going to miss that 39% rally that Tom Lee's talking about. I'm not saying we get there by the end of the year. He is, but certainly over the next year or so. And the other thing is, like, the chorus this week has been, as a matter of fact, I don't even have it. I didn't have time to print it out because I had a busy day today. But someone asked, I think it was JT Investor, Michael Burry and Soros's guy. Well, anyway, you guys know the name. They were both out today calling for the end of the world. And I'm always skeptical of people that call for a 20% correction after you've had a 20 or 25% correction. Because it's the same people that do it all the same time. And that's number one. Number two, you have to keep in mind that global macro managers, number one, they get paid to scare the shit out of people so they can charge 2 and 20. That's number one. So when, and number two, they tend to earn their money, because while they underperform and generally don't earn for 10 years at a time, in the 1 year every 10 years that they do earn, it's usually triple digits. So when you take it annualized, so they'll be like negative or like mid-single digits, and then they'll have a big 30 or 40 or 50, in some cases 100% years. When you annualize that, it's like they can then say after that big hit, well, annualized, we're up 20% a year for the last 5 years, even though it was like -5, -2, +2, while the S&P was up like 20% all those years. And then they get a big plus 80 or plus 100 every 10 years, and that gives them long-term performance. But 9 out of 10 years, they're wrong. It's just that 1 year they can make up for it if they live to tell the story. Most of the ones from the great financial crisis didn't live to tell the story, but they made enough money that it didn't matter. And the few that are around now are making hay while the sun shines this year, and they're all positioned for it to go further, so they've got to pitch that hard on TV. And they believe that. I mean, I'm not saying like it's like some grand conspiracy. That's what they believe. That's their DNA. Just like Buffett's DNA, no matter how pessimistic things can get, he's always generally optimistic to buy high quality businesses on sale, and he's always right. And he's not, 0 for 10 and then 200 in 1 year. He's more like 20% a year over time. And you can look at his drawdowns when, in his first 20 years, he had some negative 30 and 50% drawdowns, actually quite a few of them. But over time, you buy high quality, you win over time. So you just have to take that with a grain of salt. I mean, I'm not going to single out any of the speakers. You all know who they are in the last couple of weeks calling for bigger drawdowns. But just Google those people who are bearish after the house is already burned down, and then just Google by name, by year, and then just put their name in 2011, put their name in 2012, put their name in 2013, 2014, 2015. The people who are bearish this week, by and large, have been bearish every year for the last 10 years while we've had a bull run. So you have to just have your own metrics, have your own system, and see what makes sense. And if you think it makes sense to get bearish after everything's already happened, not to say you can't go lower, when all of these positioning indicators, everything are at extremes, seen at times where you've had massive turnarounds in the market. If you think this time's different, then have at it. But I think if you consider the weight of the evidence and you look at positioning, you look at the underlying economy, you look at how central banks have had to ultimately react regardless of what they said throughout history over the last 110 years. You look at the palpable pessimism and you draw your own conclusions. So you can listen to the pessimism. Maybe they'll be right and they'll get another 5% or 20% or whatever they think is coming, or no returns for the next 5 decades. I've heard that forever. That was a big one in 2010, by the way. No returns, and it was the best 10 years. So take it with a grain of salt. I mean, I just try to guide you through the facts that I'm looking at. You got to draw your own conclusions. I mean, whether it's one guy or another guy, you take it all in, see what sounds logical, and draw your own conclusions. I'm going to always attract the type of people who are like me, who when the house is on fire and everyone's running out, they look at the opportunity and they say, wait a second, this was a $10 million building. The fire is going out. Maybe the owner will sell to me at 80% off right now because he thinks it's never coming back. And you look around and you're like, oh, wait a second, that's the Empire State Building across the street. This might be a good location. After the smoke clears, it may be worth 5x 5 years from now. And that's the way I look at things. And some people have the stomach for that. Most people don't. But it's a formula that's worked for me, and it's going to continue to work for me. And that's that. But some people will naturally identify with the chronic pessimists, and you just have to make sure that you follow them in the right year when they make 100%, because not the other 9 years they're going to be negative or barely positive when everyone else is doing extremely well. So I'd rather compound at a regular rate than have a once in a 10-year pop. So which central banks will blink next? So we covered this. Bank of England did it. You can pull up the articles here. Authorities in Indonesia, Japan, China, and India are stepping to defend their currencies. The Fed is next. Just yesterday, Charles Evans said he's feeling apprehensive about the U.S. central bank raising interest rates too quickly. You'll start to see more of those as there's more volatility. The Fed is hiking further and faster than at any time in modern history. They do this until it breaks. What breaks, first thing you see is the high yield credit market. So let's see how those are doing. And there you go. You got a double bottom. You got them near the last time they had to step in and backstop the corporate credit market, which was the pandemic lows. So we're not quite there yet, but we're at a level where they should be sweating some bullets and thinking about how they're going to pivot. The way that I would do it is very simple. You could save face and simply say, in no uncertain terms, we've just done 3 emergency hikes, unprecedented, out of 88 hikes since 1983, 75 of them have been below 50 basis points. We just did 375 in a row. We want to see the data come in over the next couple of months. It's fully our intention to do another 150 basis points to get to 4, whatever magical number they came up with, 4.6. But if the data drops in the next couple of months meaningfully, we will take a wait and see approach. If it doesn't, we will immediately finish up that 150 basis points. And just give themselves some optionality versus the autopilot stuff that's gotten them in trouble over and over and over again, like 2018 all over. Deja vu all over again. You would think people learn from their mistakes, but some do, some don't. Okay, some technical indicators. We've covered all this sentiment stuff. This is the high yield credit. This is the number one. As important as the dollar and the 10-year yield is, keep your eye on this. This is what usually causes the Fed to pivot. and that's when they had to formally backstop the credit markets during the pandemic lows, and the market just took off after that. XBI, most oversold ever. That's from ISI. Biotech update. So we had this 57% move off the May lows, and now it's consolidating before its next move higher. You can see the longer term view. It does that bottoming, then you get 3 months, and then you get a red month like we're having here to just shake people out. And then it's just a slow grind higher until you make new highs. And, that's another 100% on the XBI, more if you have different instruments. We think that's going to be a great opportunity. By the way, this was up 140% off the lows in 2 years during the last tightening cycle when they took the Fed funds rate from 0 to 225 or 250 in 2 years. So what were the two catalysts we covered months ago? Major deal progress, which we've had. It's slowed a little bit in the last month with rates going up, but there's still some smaller deals getting done. $1 billion deal got done this month. But the big one is the major drug progress. The Biogen news this week is huge regarding Alzheimer's. The 27% efficacy means more likely than not, Medicare will cover it. If that's the case, you're going to just see all kinds of money go back into drug development, into this space, into Alzheimer's, and it's going to be game on for biotech and speculative drugs that are getting approved and worth a windfall. In this case, I think $40 billion estimate or something to that effect. Alibaba update. Again, if you step back, all the noise in biotech, and when you look at it, it's really just 4 bars, and it's actually moving in the right direction. It feels like death. It's unbelievable how the day-to-day can throw you off. Baba, this thing, day-to-day could drive you to a mental asylum. But if you step back and you look at it, this is doing exactly what it does at every major bottom. It sucks people in with a big abrupt move up, like we saw from 73 to 125. Here it did 57 to 86. And then guess what? It went back to retest the 57. It got down to 59.25. And then it went up 300% to $211 within a year and a half. Same thing here. It got down to, looks like 140, went up to 195, collapsed down to retest around 151. And then it doubled within about a year, just over a year, from 150 to 319, so 100 and something percent. And then here we are, 73. It shoots up to 125, back to retest around 80. If you remember, actually, a couple months ago, I said, I hope we don't have to do this, but more likely than not, they're going to do this to us just to get all the people that got sucked in at 125 back to 80. And then we'll get a catalyst, whether it's the China National Congress or this auditing thing. The auditing thing takes about 8 to 10 weeks. I did play golf with a partner from one of the major accounting firms, and he said, they'll drag it on a little bit so they could collect massive fees. So maybe that won't be the first catalyst, but it seems to be that it's got to get done by the end of the year. So we'll see how that goes. China Airlines finalizes a landmark order for up to 24 Boeing 787 Dreamliners. This doesn't happen without the government's blessing. So maybe the U.S. and China relations are thawing a little bit, either by necessity or by desperation. What are the U.S. audit regulators, inspectors doing in Hong Kong? This is from SCMP. And they're saying here, one thing is certain, Williams said, by the end of this year, the PCAOB will make determinations whether the PRC authorities have allowed us to inspect and investigate completely or if they have continued to obstruct. And you can read that full article here. And then Cooper Standard, on the one hand, you had this 240% move off the lows after they reported earnings, cash flow positive. Now you're consolidating. It feels like, oh my God, it's everyone forgets how it went from 353 to 1159, but now that it's down to $6, I think it was down to $6 today because CarMax reported used cars. The reason used cars are down is because supply is coming on, which was a part of our thesis because the semiconductors are coming in, so the new car supply can get out, so the demand for used cars, so it's like the thesis is playing out. But like we've continued to say, just like this fake out the last time they had this in the middle of the pandemic before the semiconductor shortage, bottomed at 664, shot to 18, and then they took out half that bar, probably from 18 down to like 11 before they, to get all the people that jumped in at 18, shake them out, get all the people that jumped in at 11, shake them out. They'll probably take it back down to 6 or 5. Well, they did 6 today, so it's probably down there. And then in the coming months, it'll just rip their faces off upward, whether it's earnings as the catalyst, which could very well be, or they get the refinancing done. But if you look at the liquidity, I was thinking about this last night. I think about it every night. $400 million, 200 on the ABL, 200 in cash. They don't even need to refinance. If they do the 40 or 50 million of EBITDA, plus they do they're getting some more tax money back, plus they do a couple more sale leasebacks, they could just pay the damn thing off and not even refinance it at all and just do it out of cash. So everyone's worried about the refi, which may not even need it, and they've got over a year to do it. So my sense is they'll probably do it anyway because they don't want to draw down on all their cash and credit lines, but they actually don't need to. So there are a lot of outs here, and that's very important whether you're investing on a catalyst or you're playing poker. You're always looking for outs, and that's one of them. So the refinancing would just get this huge spike up more quickly, there are many ways to win with this one, and we continue to watch it closely. AAII sentiment 20% bullish. Again, these are pandemic levels and great financial crisis levels. Fear and greed down to 19 is probably a lot lower. My guess is it closed at 15 today. I haven't had time to look at it. And NAAIM, this is hysterical. Look how low that got. 12.61. It was 10.65 in the midst of the pandemic. This is like unbelievable. The amount of chasing that's going to be required is going to look exactly like this. Any bit of good news, and it's just going to keep going, and no one's going to be able to catch it. And that's what's going to happen. And here's what blows my mind. Carter put out some earnings. We did the top 30 weights of the retail, which is mind-boggling to me. They actually went up, not only for this year, but for next year. The top 30 weights, earnings estimates. So you get all these guys on TV, estimates are coming down 20% this quarter, like they said last quarter. Earnings are actually up in the last 60 days for retail. For retail, the consumer, retail, up 46 basis points for this year, for this year, and 55 basis point, 0.5% for next year. That's mind-boggling to me. I thought those would be down 3 or 4%. Even transports, with FedEx crapping the bed, these earnings this year are up 62, 0.5% in the last 60 days. The top 30 weight transports, and they're down 2.74 for next year, and that includes FedEx guidance. That's mind-boggling. It's not to say they won't come down more, but the fact that they're not budging is in line with what I'm saying about nominal. People are forgetting about price increases. Even if in real terms they're doing less units, they're charging a lot more per unit, and that's why earnings can continue to stay stable even though we've had a recession in the first half of this year in Q1 and Q2 of negative GDP growth, and Q3 was probably negative also. And after the election on November 9th, they'll have to officially declare that we already had the recession. People will start to go, is this like April of 2020 when I was really negative and the market had already bottomed in March? Is this like March of 2009 when I was really fearing a recession, and then a few months later after the market was up 100%, I realized the recession was already in the rearview mirror? So let's see what happens. No one has a monopoly on being right on any of this stuff, but if you've been through enough cycles and you've seen the sentiment and studied and spent a lot of time on that and positioning, it can give you an edge over time. Bottoms up estimates are still at 242.31. So everyone called for 20%, and you've gotten 3%. So from down from 250 peak to 242, and we'll see what guidance looks like in coming weeks. Now, tomorrow we've got some important numbers. They are backward looking, but they are important. Core PCE is the Fed's favored number. It's expected to be up 4.7% year on year. Maybe we'll get lucky and get something that comes in lighter than that. But if not, we've got the jobs report next week. It's interesting. They've got 1, 2, 3 Fed speakers right at that data point, or right after that data point. Let's see, 1, 2, 3, 4. 4 Fed speakers after that. Then you got consumer sentiment and everything else. So tomorrow should be an interesting day. We'll see how that plays out. But wanted to get you my latest thoughts. Hope you found that helpful. We'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now.